just going down the row here, starting with to give a brief introduction to who they are and kind of what you look for and are interested in the investment space.
We're very excited. We look for opportunities specifically in the alternative space, so private equity, venture, real assets, private credit, and we're excited to be here, so thank you.
Okay, good.
We're a group of 12 investment professionals specializing in working with founders who are kind of planning for a significant liquidity event 12 to 18 months out and helping them plan for kind of the issues that they face prior to, during, and after that transaction. That's us.
We're a bona fide family office. We have a tax department, a CFO department, and of course investments. And so we handle clients from all over the country. We have offices in New York, in Florida, and Los Angeles. And our primary clientele are folks who are usually first generation wealth builders and business owners, entertainers, basically anyone who needs advice and planning. We're there to help.
So nice to be here with you. Similarly, we serve a similar clientele. We, as a multifamily office, focus on helping people who are undergoing exits or who have significant means, but maybe not quite enough to start their own family office. We pride ourselves on being tax savvy and on investing in alternatives like private credit, private equity, and real estate. So for those purposes, it's great for us to be here at this conference.
I also have origins back in California. After Alaska, went down and studied at Stanford, there in the Bay Area. And I was almost a New Yorker back in this area, in that my first job offer was with Peter Lynch with Fidelity Magellan out of Boston, and had another offer from New York, but instead I chose to go back to California and started out there. Partly because I had mentioned earlier that you should put character first. I put character last when I first started out and was just focusing on money and not on character. So what Peter Lynch offered me was less than what I thought I could make in California, and went there and found out that as I was starting up the company, because Peter Lynch said right at the beginning that really, if I just was right 56% of the time, that the 56% should far outperform the 44% that were losers. And I figured with those kind of odds, I had to just start my own firm because we should be able to do pretty well with that. But instead, that first year, I made $7,000 instead of $70,000, and it went from there, thankfully, upward.
Well, okay, so I'm not going to let you leave that hanging. 7,000 in your first year. I won't ask you how much in the second year, but I presume some more and some more. And that was a long time ago, maybe 20 or 30 years ago when you were doing that?
37 years.
37 years. That's impressive. And the firm you started then is Pinkerton that you are today?
Yes. Mm-hmm.
Okay, that's impressive. I made this comment yesterday, and I was one of the panelists, and that's the way to build wealth, is to find something you can do pretty well, maybe very well, and do it for a long time. There is no quick money out there, so you've clearly been doing that. So, now that you're a rich man, you gave a lot of discussion yesterday about the various funds in the public markets that you manage and offer and how you've engineered them, and you gave this great example of a Ferrari, and I'm now terrified of getting in a Ferrari because it won't have a steering wheel or brakes or whatever. But let me direct you away from all of that to what you do as a person for your own assets that are not in your business. What's a kind of investment you're looking for these days, or would look for, are looking for your personal assets?
Sure. So personally, I invest also where I recommend our clients to invest. So our highest net worth investment clients typically are looking for those areas that we specialize in. And so each of us have different specialty areas, and typically then people will then tend to gravitate towards those areas that they're most interested in. And those that have gravitated to us oftentimes have been those that have invested like in the Great Recession and lost 57%. And they said that's never happening again. And then some gravitated to real estate and have not done well in the last couple of years in a number of those areas. So they've been looking more at advance and protects. That's our specialty area. That's how I invest personally. And
But I'm not going to
what we
allow
do.
you to give the answer of what your firm does. Specific investments. You dissed real estate, and you dissed some other things. What do you look for? What's your portfolio look like outside of your business? You obviously have money in your same portfolios you got your client money in.
Sure.
But out of that, besides that,
So yesterday when I was the platform speaker, you saw our office. So we've got a very nice office. So we obviously invest in real estate from that standpoint. But my personal portfolio truly is where we diversify our clients.
okay, all right, I'll take that. So Isaac, let me come back to you. You said in the materials you sent me in advance, and thank you very much for doing that. It was very helpful, even though I'm not going to now pay any attention to them. Sorry. You put in there that you like to meet managers. One of the questions that I'm supposed to ask these people is, what kind of managers do you all want to meet? And I'm not going to ask that question. Sorry. But you put down that you look for top quartile managers. Funny thing, I've never met someone who wasn't top quartile. My data set must be broken. But the question I want to ask you is, once you've found those top quartile, what are you looking for? What helps you distinguish the one who's going to get your money once you've got 3 or 4 top quartile folks?
Sure. I mean, look, anybody in my seat, I think it's important to be compensated for illiquidity. And if you're going to be illiquid, you have to get paid for it. And so as important as performance is across capital markets, private markets, if we're going to be in private markets, we have to perform. So from a performance standpoint, that's number one. Number two, we have a pretty intense due diligence process. I think part of being in our seat away from the wirehouse is the ability to be in rooms like this and meet different people across different asset classes. And it's up to us and our team to put different investments in front of our clients. And so at the end of the day, once we do meet those people, it's about terms and size and what platform and how we invest, and we put those in front of our client base to generate efficient beta. At the end of the day, we get paid to manage money, and so we want to make sure we put qualified folks in front of our client base.
Did you say generate sufficient beta?
Efficient.
Efficient beta, as opposed to alpha?
Alpha, excuse me.
Alpha, yes, okay.
Efficient alpha. And so, again, it's, we look across the investment landscape, and especially in the private side, if we're going to be in that end market for our clients, it just has to make sense, that's all.
And I know you probably shouldn't say this, my compliance guys would object if I answered this question, truthfully. But what do you invest in that is not in your clients' portfolios?
Sure. I'll answer. I guess that's part of not being at the wirehouse anymore. So we definitely don't have clients in crypto, I'll tell you that, honestly.
I'm pleased to hear that, actually.
Truly.
Neither do I.
Yeah, it's just, I won't get into it. But to answer your question, I guess personally.
Some kind of fun things.
Yeah, exactly. It's I won't get into it. But
maybe I'll jump in with sort of an answer for me to the question I'm kind of working on now, and we'll get to the rest of you in a moment, and make that point that you're actually maybe making. I got advisors that take care of whatever little bits of money I actually have, and by the way, I don't use my own firm to advise my family money. I find that a strange dynamic. I don't want to go to. I want to come to Thanksgiving dinner. Okay, so if it's my firm that's screwed up, I would not be invited to Thanksgiving dinner. Anyway, but for me, I'm a business builder. Spent most of my career building software companies. I love entrepreneurs. I love entrepreneurship. I love that path. I look for private direct investments in individual, typically smaller companies, where I can add value to the management team. Now, I'm not looking for that. Please don't come up afterwards and tell me you got a great opportunity, because I'm not. But that's the kind of thing that does drive me, that has driven me, and I do have some of those, and would drive me. And that's kind of where I stand. And it's a little bit like what you're saying. There are some things that excite you, that get you empowered, and so maybe that's where you go. So are there things that you would look at that maybe your clients aren't seeing so much of?
That's a good question. We invest alongside our clients, so we eat our own cooking. We wouldn't invest in anything that we wouldn't, put our clients into. So and I do have to be careful
Well, yeah,
in terms
of
of,
course there are
but from
reasons.
like a broad perspective.
There are reasons for that, though. I mean, you're right. You can't be public about investing in things that you're not giving to your clients. I mean, there are all kinds of issues there. But the truth is, your clients, and in fact, you said that your clients are typically founders, maybe facing a liquidity event at some point in the future.
Correct.
So we'll come back in this in a minute. They need a certain flavor of investments today while they're waiting for their whatever. But you're a very different person, or maybe you are waiting for a liquidity event when you flip the business for billions of dollars. But you are allowed to have investments that aren't the same as your clients.
Of course.
You just don't want to be too public about them. But give us some thoughts. What kind of universes would you explore that maybe aren't going to be suitable for your wealthy founders looking at a liquidity event?
How do I say this? Well, so, a founder, has this kind of safety net, this bucket of capital that no matter where the market is going, up, down, sideways, is bulletproof.
Yeah.
And super safe. And then there might be 5 to 10% of the family's net worth that's carved out to do kind of interesting esoteric things. And
What
I'd
are some of
say
those examples? Private directs.
yes, or secondaries,
Venture capital.
VC, yeah, later stage VC. We don't get involved in kind of the
GP-led
seed
buyouts.
and yes. But I wouldn't say I don't invest in these things.
Yeah.
My clients. So it's
Peter, I did like your question about what do you look for in a manager that might be distinct.
Yes.
Can I take a shot at that one real quick?
Please do.
So two things that come to mind that we really love in a manager. Returns obviously are a huge factor, right? But when I see moat and I see ecosystem, I get excited. And so I think about this defense industry buyout group that I mentioned in my talk earlier today, right? So these guys have been doing for 30 years. Do they have a moat? Absolutely. So their 4 partners have high security clearance. They can literally walk into Langley and keep going, right? So that to me is a moat. That is not a business that a Goldman Sachs or Morgan Stanley can say, we want to be in defense industry buyout tomorrow, let's go, right? It takes a minute. So there's moat. And then ecosystem, this board of advisors, right? To have 4-star generals, to have James Kelly on your board of advisors and to be able to say, hey, where do you think the money's going? Do you think we can accelerate the growth in this company? That is beyond saying we're going to make a CEO change or we're going to advertise more on Facebook, right? That is true value-add ecosystem. So when we find, a specialist and moat and ecosystem like that, we really perk up.
Okay, that makes a lot of sense, Greg. It makes a lot of sense. Okay, so changing the topic just a little bit. Let me jump back to you. You and I were chatting earlier, and you had an objection to the title of this talk.
Yeah, weird. A lawyer had an objection. Yeah. The title kind of begs the question of the panel here that we have mandates from clients or that we prescribe mandates, and that's not really the case. So we meet clients where they are. You can have a client that has a $500 million net worth that's very unsophisticated, has no idea what they want. We can meet a client with $5 million who knows exactly what they want to do, and they have a PhD from MIT, and they're going to use you as a conduit to get to their goals, right? So I kind of see it as our job as advisors is to be empathetic, listen, but I always say trust but verify what the client's asking us to do. So if you went into your doctor's office and you said, hey, I'm not feeling well, I need a prescription, give me a Z-Pack, they would say, I hear you, let's do some tests first, and then it might turn out that you have a completely different diagnosis than what you came in for. So, you just gotta be willing to engage with someone, be empathetic, and then I kind of think of everything we're talking about here as table stakes. If you're gonna serve high net worth clients, ultra high net worth clients, you have to have interesting investments, you have to have a unique platform, you have to have things that maybe others can't provide. You provide alpha, as we always like to say. But like I said, it's table stakes, right? What matters is that you are the node that connects them from what they think that they need. You do some work in underwriting with them, and then you have the solutions to back it up.
And that's often an educational process, too.
Yeah, absolutely.
They all think they want something, but the truth is we have to guide them as advisors on what maybe really does make sense given their situation.
You walk a fine line between being an advisor and having that type of philosophy, but not being patronizing too, right? So, our clients are extremely successful. Our job is to serve them and do what's best for them, but you can't be a sycophant at the same time, and you can't be a bully.
Yeah. Some of you have other comments on this topic or these topics? Go ahead.
Well, just to kind of add to that, I think, the core of what we all do is client advocacy and making what's important to our clients important to our teams. And at the end of the day, if a client's looking for unique, bespoke, tiny private investments, we can find those. If they're looking for a massive municipal bond portfolio, we can create that. It's really, at the end of the day, it's not about the products, it's about that relationship and maintaining trust through the generations. I'm sure your firm has multiple generations of clients being in business for 40 years, and we're the same. We have some clients that are, the patriarch or matriarch is 4 times removed. So it's really important.
And this is actually quite important. I mean, someone said to me just earlier, and we've heard it many times, that wealthy folks tend not to be concerned about getting wealthy, they're concerned about staying wealthy, and that is fundamentally a conservative thing. So Dan, I'm kind of curious. You had a lot of great examples yesterday of some of the strategies and the tools you use for helping people stay wealthy. Expand on that a little bit. Because that is part of the brakes are there, the gear shift is there, all the things that are needed to make sure the portfolio doesn't go off the rails. What are some of those key characteristics, and how would they help $100 million clients and so on?
Well, it really depends on which division of our company we're talking about there. As it relates to 401ks, we're going to have a different
Very good point.
overall approach
Retirement money is completely
there
different than
specifically.
spending money, yeah.
It's pension, profit sharing, 401k money. If it's family offices money, then it's going to be specifically looking at how can we advance as the markets are trending upward, and protecting and redirecting as the markets are trending the other way. As it relates to our hundreds of investment firms that buy our research or use our research then to trade, then it's all about the signals and having the best signals overall so that they can make money profitably.
Okay. Isaac, I want to jump back to you. I think you said, and just as context, I am a software guy. I love blockchain. I am aggressively anti-crypto. So half of you can leave now. Yep. But you made a point, Isaac, that I think you said crypto, blockchain maybe, was maybe something you might double in yourself. But your clients, by and large, you didn't or you wouldn't. Why?
Short answer is volatility, and I just don't trust it, to be honest with you. I could have a call with an analyst tomorrow about everything Apple. From what I know of, I can't do that with a coin. So
I would agree.
To put hundreds of millions of dollars into something like that just feels a little...
I might go a
tough,
little
so.
further and say that it's not just that there's a lot of volatility. It's that you can't engineer the volatility. There's no understanding of why. Well, there is, actually. I think the source of volatility in crypto is largely consumer sentiment, or even quasi-professional investment advisors who are offering it up, their sentiment about crypto itself. Maybe you could dissect and analyze that and therefore predict it, but yeah, you can't figure it out.
To listen to this full panel, join the Family Office Club by visiting familyoffices.com. We look forward to seeing you at our next live event.